Hi, Mr. Shah. How are you?
Yeah, all well, all Kamal.
Very good morning to you. Already almost 150 people that have already joined us. The topic of this webinar is that we are sure that we're going to see Indian economy as a 10 trillion economy over say next 10 years, and this entire transformation is something which I remember. I have been reading your articles in 2018-19. You have been saying India is standing at a cusp of a very big kind of economic transformation. Some may call it tectonic shift which is happening in India, but absolutely now it's more or less visible to common people also. Earlier it was a kind of a saying from wise people like you, but yes, now since it is in front of us, we know for sure it is happening, and there are a lot of questions that come to investors mind, that how to make money in this entire possibility and entire progress. There have been a lot of people, a lot of I would say investors in the chat who have been writing questions like, still over next say decade will we see money made as buy and hold, or one should keep booking profits? So all these questions, I'm just trying to give you a perspective that what all we'll be talking and discussing in this webinar. But to begin with, I want you to address the big picture question, that the thing that you had once mentioned, that India stands at a cusp of a multi-year bull run, and you also mentioned that the bull run will be kind of very different because the quality of the growth ahead of us is going to be very different. So now, since it is in front of us, obviously, we are more attentive to hear the same thing again from you, and you would also have maybe more recent and relevant data to kind of help us with. So this is the I think foremost question that I want you to address, that are we sure, and are we going to see this entire tectonic shift in front of us, and what do you mean by change in the quality of earnings, and how does that imply the progress of Indian indices over say next 5 years?
Sure. Lot of questions in that one question. So let me try answering each part. But before that, once again, sincere apologies to everybody for this delay in starting the session. Seeking your apology, and it's Michami Dukram festival, which is just which is just got over yesterday, which is seeking forgiveness. So it is in order that I seek forgiveness for this delay. The article that you talked about, that I've written, is the golden decade of India, and in 2018 or 19, I think, I can't recollect exactly, but it was written at that time. Probably at that point of time, many people might have felt, and I got a feedback on some of it, that was a bit presumptuous and a bit early in the day to, kind of make that kind of a judgment or a statement. And perhaps it was early in the day at that point of time when actually more challenges were visible rather than the opportunities, which is what I felt. But the core set of beliefs and the ideas which underpin that argument still remain not only valid, but even far more so. Because since then we have seen affirmation of many of those thoughts and ideas. So essentially, what is it that has changed is one part that we need to talk about. Second, what is it going to lead in terms of the growth rate that you alluded to? And very importantly, even more than the rate of growth, the quality of the growth, which again you alluded to. So I'll deal with that in the second part. And Third, along with that, a particular 10 trillion or of an economy in a decade. Normally, these kind of macro predictions, as investor, do not prefer to indulge in. I prefer to deal with the micro issues surrounding each particular investment, even if there is a macro background to it. But since there is a specific question on that, that will be the third part that I'll talk about. So first, let me say what is change. I mean, there are number of large changes which have happened. In the earlier part, the tapestry did not look visible because reforms were here and there, and they didn't kind of seem to add up into a kind of a larger ecosystem of its own. But today it is far more clear that many important reforms have happened, and therefore tapestry is materially complete. The shape is very visible, and therefore the outcomes likely to emanate also now acquire far greater credibility. But what are some of the big changes? I think one that has happened is the fiscal discipline, fiscal restraint, which is visible in the behavior of this government over several years, including during pandemic time, when it might have been very convenient to set aside fiscal discipline and restraint. And indeed, most of the world, including the so-called developed world, did the same and are paying for the consequences. But I think remarkably, India stuck to the gun and remained on the path of fiscal rectitude and discipline, for which it is actually benefiting today. The consequent outcome has been taming in of inflation, even though topically right now it may be a little higher, but structurally I think we have brought about enough things in the play to ensure that the inflation remains within reasonable terrain. And therefore, consequent to that, we have succeeded in taming the cost of capital. And controlling the cost of capital is very vital from the point of view of new capital formation, from the point of view of the lending need, as well as the willingness of the lender to supply the credit, also from the point of view of the asset values. And therefore, a very important material change which has occurred is a more predictable, controlled, tempered cost of capital. Along with that, the fourth factor I would say is very powerful digitization thrust that the government has put in place. It's not just the businesses, actually government is at the forefront of the digital efforts of various kinds. And typically, I think what this government is wonderfully doing is putting the basic digital architecture in the public forum, and on which top of which innovation engine is being built by the private side. Therefore, the thrusted opening up of the digital highway, I think government is really focused very well on that. And on top of that digital infrastructure highway, a lot of private level innovation engine is getting built, resulting into various new ideas. The other part is the digital public infrastructure, where many important vital pieces have been put in place. United Payment Interface (UPI) is one of them. ONDC is the other one, which is in offering. Account aggregator is another relevant idea. And even Bhasha or Lipi, which is basically vernacular language translation, which means digitization opens up to the whole country, not just remains confined to the elites. These are some of the very important and very strong reforms which have been put in place. This is ensured Aadhaar-based digital identity affirmation with a virtually universal coverage, and also has resulted into very strong the bank account penetration, which was below 20% 10 years back. And today it is almost virtually 98-99% of the households have at least one bank account, if not more. And therefore, financial inclusion along with the digitization has been a very powerful idea. PLI laid manufacturing thrust in select areas, well known, very powerful initiative. And it is not merely about inward part of what it does to the manufacturers and the businesses within the country, as some people have criticized, but wrongly. It is actually a thrust to enable strong capability in vital areas where you can't be vulnerable and dependent on the outside world. And therefore, and eventually that will also lead to building a scale to export to the other countries. And therefore, manufacturing ecosystem being kick-started in full earnestness is a very vital big change which has happened. I would say even urgency the government has shown and initiatives which have been taken in order to build India as a very credible, reliable partner in the value chain or in the world. I think this has come perfectly at the right point of time, and therefore India is increasingly in various areas is being looked upon as more trusted and more relied upon partner to do activities, and which is something to the huge advantage of the businesses. The thrust on infrastructure, well known, the speed with which new roads and the ports and the airports and the railway system is getting built, all of that will lead to logistics revolution along with the Gati Shakti project and bring down the logistics cost, which is an important area of cost for the businesses, but it will also spur efficiency and supply chain efficiency and revolution. Along with this, finally, the transparency, the direct taxes, digitization, and faceless assessments in direct taxes. We are seeing the power of GST revenues and realizations surging ahead. We also saw the direct taxes, the first half collection going up by more than 20 to 23%. All these are very clear indicators of the transparency that has been brought about into the system, which is important because it leads to improved quality of the growth, as well as it results into capital which circulates in the economy rather than capital which is hidden below the pillows and the in the bank account, bank lockers of the people. These greater transparency in the businesses and into the public taxes behavior is something which will improve not only the governance and strength of the resource raising by the government, but also eventually lead to greater quality of the growth and superior capital efficiency because the more capital remains into the circulation. Uh, Finally, I would say I think confidence and belief. This is something Very vital, understated element, but very important element. Businesses, when they have confidence about future, they invest into new businesses or expansion of the businesses. When investors have confidence, they invest into the markets. And therefore, confidence, self-belief are very important elements. I think at this juncture, probably it can be safer to say businesses and investors in this country probably have greater confidence than virtually any other place in the world. And therefore, this confidence into the future, its longevity, is a very vital, important piece that also results in people taking longer term view of the opportunity, improving the valuation of the businesses, and deepening the strength of the markets in the process. Coming to the middle part of the question is to why is all these represented by superior quality of growth? Look at the lenders. Their balance sheets in last few years have undergone transformation. The balance sheets have become cleaner, asset quality has become robust, and today safely one can say Indian banks are probably among the brightest lot all over the world, including the Western world. And all that has happened because banks and other lenders have cleaned up their books, improved the quality of the assets. Credit culture itself has improved remarkably, and all that raises the capability of financial infrastructure to support growth in a much more healthy footing. On the other hand, if you see, even the borrower balance sheets have improved. The debt equity ratio of the borrowers in March 20 compared to March 22, while it was in the pandemic time, the debt equity ratio has actually come down in this particular period. And that speaks about the improved quality of the balance sheet of the borrowers also. Second telltale indicator of the quality of growth is a return on capital employed and return on equity. And return on equity today in Indian corporate sector, when the final numbers are compiled for March 23 year, in all probability, might be one of the best in the world, if not the best in the world. And therefore, that quality of growth is something which is at the root of far important greater value creation, which is something which has happened along with the improved quality of the balance sheet. It is the improved capital efficiency which is at the root. And the third part of the quality of the growth emanates from the confidence that I alluded to earlier. When you have greater belief about the future, when you have self-confidence and self-belief about your place under the sun, I think your ability to take a longer-term views on things becomes much stronger. It allows you to invest into the future that you envisage, and therefore, all of this results into greater predictability, greater solidity, greater reliability of the future outcomes and the future growth rate. These are very vital, important qualitative aspects of the growth. One thing is growth in itself, which is vital and needed element for value creation. But the quality of growth in terms of its durability of growth, predictability of growth, solidity of the growth, confidence about it, all these are qualitative aspects and they aid to the rate of growth is an engine to drive return along with that superior element of the quality of the growth. Finally, uh, whether India will be a 10 trillion economy in 10 years' time, I think that should be hardly a matter of any surprise. I think we are at a cusp of, and I'm repeating what I mentioned in that article in Golden Decade ahead of India in 2018 or 19. But we are at a cusp of one of the greatest periods of economic expansion in this country. And the rate of growth will not only be superior compared to India's own past, but I think superior compared to virtually every major economy around the world. Secondly, it is not just the rate of growth, but the quality of growth, which is equally vital. And that is the second important part, which is driving that value creation agenda. And third, when it is durable over a longer period of time, then that strong growth and quality of growth together with its durability completes the final piece in terms of the value creation pie. We are at about 3.5 or trillion is an economy, and therefore it'll. I need to do a little bit of maths on that, but in 5 years' time, whether this economy will be about 7 or trillion. I think 5 to 6 years time, I think it is reasonably clearly conceivable that it will be. And thereafter, if it grows at something like another about 8% or thereabouts for another 5 years, then it should be about 10 trillion. Therefore, all put together, I suppose about 9% nominal growth of the GDP over a 10-year period, somewhere around that number, should make the economy at about 10 trillion. Whether that is possible, I think it is highly realistic possibility. So there is nothing very surprising or particularly noteworthy, but it is simply an outcome of strong growth with a superior quality of growth, which makes it more sustainable and durable over a period of time. That is it works in order to make this economy 5 trillion and 7 trillion and 10 trillion and 15 trillion and 20 at some stage.
Bharatbhai, I think you have addressed the big picture question uh, very interestingly, and there are a lot of, I would say, new insights that you have also brought. We'll cover more of fine questions now, maybe going ahead. I will just request you to maybe keep your answers little short so that we can cover more
Sure.
aspects. So all of us understand that yes, growth ultimately brings the rise in stock prices eventually, and we know today markets are at a certain valuation, and obviously valuations in equity market investment practice does matter. But at the same time, we also understand that it is the relativity between fixed income and equity which is dictated by interest rates, which actually brings the flows towards one asset class. And today interest rates are at close to all-time highs, especially in US. In India also interest rates are quite high. And when this decade had started after COVID, when everybody was like fearful of ultimately the side effect of Keynesian economics that world had followed to combat the possible problems of COVID by reducing interest rates, was inflation, and then to combat inflation it was a rise in interest rates. Now we are at kind of all-time high interest rates. There is a possibility that interest rates may not fall soon, and when interest rates went up this high, it was many fund managers used to come and say that till the time interest rates don't come down, we will see equity and fixed income returns to be similar. Equity returns cannot be higher, irrespective of India's economic growth. Though obviously this has not been true over last 3 years in this decade, and that all the more accentuates the worry, because now we are at kind of at a level which is at all-time high in terms of prices also, and interest rates are also high. So hence this realistic question which investors always want to ask, they are unable to maybe ask this question because one always kind of feels either fearful or greedy, and these kind of levels makes one both fearful and greedy, and one forgets to ask this question. But this is, I think, fundamental question which everybody wants to ask, that over next say 5 years we will see economy growing, we'll see earnings coming, we'll see quality of earnings. But if interest rates are high, how is it possible that equity returns will be equally good as we have seen in the past?
Uh, Number one, I think we perhaps are mixing up higher interest rates in the Western world compared to the similarly relevant interest rates in India. Western world, you are right. Europe and America, interest rates are unlikely to come down in hurry. Their inflation levels are still higher than in India, and structurally they are facing issues, and therefore clearly they have to deal with interest rates which they have not been accustomed to for a long period of time, especially Europe. European worries are accentuated because of their relatively more static and low growing, less innovative economic structure, and therefore their issues are far worse because ultimately you are able to outweigh the problem of the high interest rate if you are able to raise the productivity of capital, and eventually that will lead to capital flowing into those activities, and eventually that supply of capital will bring the cost of capital down. But Europe and US legitimately will have to contend with higher interest rate, and that is the struggle they are going through. But the problems of the West don't automatically become problems of India. This is how we used to think about it always in the past, but it doesn't have to be where automatically the problems of America and problems of Europe have to become problems of India. I think we have done well in our economic structure. And therefore, we have displayed fiscal restraint and discipline. We have we have taken steps both on the supply side as well as on the creating right kinds of enabling structure in the financial system, where cost of capital inflation is brought down and cost of capital remains in a reasonable range. Our interest rates today are not highest. Our interest rates are much lower than what they used to be 10 years back. They may have gone up compared to what they were a few months or a few quarters back. But I suspect this is a bit more tactical. I don't think it is structurally at an elevated level. Even 10-year bond yields are at about 7.17 or thereabouts. So I don't think the interest rates are at an all-time high in India by no margin, by no data that is correct. In fact, interest rates have tended to moderate. They may have technically gone up, as I mentioned just now, in recent time, but I believe it is not going to remain at an elevated level for a long period of time, assuming various supply side initiatives and the how we've been able to attract capital of all kinds, not just equity capital, but in venture capital, in private equity, in the fixed income, and various innovative structures like REITs and InvITs and others have happened where billions of dollars of capital is coming about. All of these, along with the more money into FDI, into the businesses, because India has made herself more and more attractive for the rest of the world to invest in. And therefore, I would assume that cost of capital actually will look more and more bearable in India over a period of time. You're right. If interest rates are very high, then obviously it's an enemy of value creation, and therefore equity markets cannot really go beyond a point because it will have a reflection on the relative value comparison between fixed income yields and the equity yields that you generate. But we are not in that situation to best of my mind. Also, while valuations may have gone up in many pockets and many individual names, but in general, valuations have improved. They are not in a territory which you can say are damaging or scuttling the very basic idea of investing. And I would say valuations are far from that kind of an elevated level. They are higher, certainly, than what they were a few months back when everything looked to everybody, to the most people, very morose and gloomy and difficult with the war going on and supply chain disruptions and raw material price inflation, freight and other disruptions that the world has been going through. All that made people somewhat diffident and worried. But here we are in that walls of worry. Actually, markets have risen and have gone up. That is, therefore, markets have indeed risen. They are near one of the highest points in its history. But again, that's not surprising. If earnings are going to grow and if they are qualitatively sound, it will reflect in stock prices and therefore indices, and therefore routinely indices will touch new highs. There is no magic about it. It's purely mathematical, and therefore I'm not deeply concerned about the aspects that you mentioned. Certainly, Western world is a lot to worry about, and therefore Western markets are taking more time to arrive at the new peak. Simply because they are running some deeper structural issue, while Indian markets have broken through and have reached and have been attaining some new highs time to time.
Right, Bharat Bhai. So now, we have come to this.
Just one more point. I mean, of course, this long-term journey, value creation, it will not be free from volatility and violence occasionally. Volatility is almost a given. Occasionally, there'll be violence as well. And therefore, there is nothing which is a very easy ride that markets offer. There is constantly a challenge, a gauntlet which is thrown by the markets at you. So that will happen, but through that patience, ability to see the eventual picture, ability to stick by that rather than get carried away by temporary distractions. Time to time, in a rising market, there will be distractions. Things will get popular, which some of them may or may not deserve to be popular. And yet they may get popular and they may overreach themselves. The prices may overshoot. All this will happen. Time to time, markets may also run ahead of themselves, but eventually, through that to and fro kind of a movement that markets will keep making, the net curve will be upward sloping, rising kind of a curve over a period of time.
Sure, Bharat Bhai. So now, let me ask you a few more fine questions. We have seen, over last almost 2 decades, ASK Group under your thought leadership delivering returns of close to 18 to 20% on ongoing basis, and the longevity of return has actually created wealth. If one has to talk about wealth creation, that doesn't happen because of 1 year of return or 2 years of returns. It happens because of longevity. And you had covered this aspect that yes, consistency of performance is even bigger thing than maybe alpha, because alpha comes in few years, but consistency ultimately over longer period of time because of longevity creates wealth. Now, in last 2 decades, when you kind of were instrumental for all these returns at ASK across all these portfolios have given, and now at this juncture, when we know the future ahead of us is different than the past in terms of the gigantic shift or the kind of cusp or the kind of quality or a broad-based possibilities. I have always seen ASK's portfolio mostly around few very well-known stocks, and obviously all those moated well-known businesses have actually delivered very well. But today their valuations are high, and maybe the opportunities are much more broad. As we know, the future ahead of us is kind of not just a future which is going to show growth, but as you said, very high quality growth. So in today's competitive environment where there are so many other portfolios also wanting to participate, and investor looks for that competitive edge, which is something that you would have because of that wisdom and experience. Has your philosophy over time changed, or you want to continue with the same philosophy? And if it is changing, what is that change that investor should be getting guidance from you?
No, you're right that set of opportunities is widened without any doubt. One can definitely think that the entrepreneurial thrust of the country, which is again one of the significant changes that is happening in the economic fabric of the country. There is a newfound entrepreneurial hunger and entrepreneurial thrust to drive into the future and meet with the value. And therefore, lot of new businesses are springing up. Government on its part is enabling various ecosystems. The Atmanirbharta is one very vital one that we see, but there are many other aspects which the government is being carefully articulating and creating the ecosystems. And therefore, without any doubt, number of new opportunities will spring up. Startup ecosystem is one outcome of that, which is a repository of innovation, entrepreneurship, and new business models. And even if some of them fail, enough of them still will create value. And it is vital from the macro ecosystem point of view. So many of these changes is clearly widening the basket of opportunities and the number of new areas of opportunities which have come by. Uh, some of it may appear to be a fad, but may not be actually a fad. There may be a real opportunity. Some may turn out to be relatively be more short-lived and may be shallow, but may be popular. And some others, the traditional ones also will will continue to deliver and will continue to weave in that opportunity going ahead. We'll have to have a careful amalgamation of all of these. There are strong and solid ones which have done well in the past, and so long as you believe that they will continue to do so in the future, then they have a space in the portfolio. Then there are new opportunities, brand new opportunities which are coming by. Some may not be as deep as they may appear. Some may be deep, others may be shallow. We'll have to appropriately look at each of them, but there is absolutely no doubt there are a number of new areas which are springing up, and many of them will produce some very interesting and very powerful businesses. And it is our duty to look at each one of them, whether we like them eventually in terms of including in the portfolio or not is a separate issue. But we have to look at them and carefully consider rather than be in a state of being dismissive about them. Including, I would say, many of the startups which have been listed. Many of them, or most of them, have found it difficult to really produce any meaningful outcome so far. But I would not dismiss them away. I would say they deserve a look, and at an appropriate point of time, some of them may have a reason to be part of the portfolio. But apart from the startup and more innovative kind of listed opportunities, in the traditional area or in some of the new areas, many interesting companies are coming up. Some may become very substantial ones. Some others probably may not be able to scale beyond the point. But again, huge number of opportunities. And we have to find meaningful names, meaningful opportunity from this space and put it in the portfolio where appropriate. Finally, we also have to be careful to not succumb to short-term attraction as a permanent long-term value creation engine, because in a rising market often red ratings come by, and therefore time to time there will be opportunities which may look enticing but may turn out to be a problematic over a period of time, and therefore we have to remain appropriately balanced, objective, and dutifully judgmental, so as not to we can't fall for trees and miss the woods. Equally, we can't disregard many new names that are coming up and not look at them. Therefore, constant agility, willingness to engage with new activity, new businesses, discomfort or dissonance that may produce, we have to live with and we have to enjoy it. And I think India on Rise will produce many of these opportunities, and I remain very, very excited that number of new opportunities may spring up. We are actively looking at many of them. Some have already been included into the portfolios. You may not probably see as many of them in our larger portfolios, but in our relatively not so large portfolios, you will find many of the names which are very interesting and enticing. And there are some more also which are in the process. So there are many more that we are looking at inducting into the portfolio, both large and not so large portfolios. Even in larger portfolios, we are carefully in a meticulous way, but in a purposely way, we are making changes where appropriate. But you can't make a change for the sake of making change. Change has to be substantive, it should be durable, and it should be value creating. And it should not be a shallow one or a shorter term one. And therefore, we have to appropriately bifurcate. And where we see those deeper, longer term, substantial kind of opportunities in all kinds of portfolios, it will find the space. And that is the job, that is the duty. And we have to remain on the toes for hunting for those opportunities. There is no other way to do it, and that is the dharma, that is the duty to do so. So we are pretty much aware and rather excited about that opportunity, I would put it.
So this is
But
quite.
the philosophical part, that is something is not tactical. Ultimately, idea is to create value, and value creation principles are pretty straightforward and simple. Good businesses are run by good people, honest people, capable people in a large size of opportunity will grow, and that growth, when it is qualitatively sound, it takes a second layer of value creation apart from the growth. If a growth is one engine, quality of growth is a second engine, and buying with a discipline at a margin of safety is a third engine for return creation. First two engines are the annuities, and the third one is a one timer, but all three are important, and therefore that philosophy to do what is sound and solid, which is aligned to settled principles of value creation. Clearly, there is no merit in kind of jettisoning or trying to put it at short-term convenience behavior of the market. But within a robust philosophy, application of that philosophy to new opportunities and ideas is of paramount importance. Time to time, something in the portfolio may become less valuable or may become, less interesting enough, and some of it will have to give space. And there will be some new opportunities which look even more enticing and exciting, and therefore they do need to be considered. So it's like garden, you prune, you weed out something, you replant, you plant a new one, you decorate, trim, you do all of that. You do the same with investing. Today, that opportunity is far more exciting to do more, to raise the innovation ratio of the portfolio and to raise the bar on that. And that exciting opportunity, I'm in complete agreement with.
Sure, I think this is quite comforting, and this all the more, I would say, increases our confidence on ASK, because you are basically saying that you are approaching the upcoming opportunity with absolutely open mind, And given your experience, we are absolutely confident that the additions and the kind of changes that will be done in the portfolio will absolutely bring alpha and will continue the longevity and consistency. So moving on to the next, question that comes to my mind, if I put myself in investor's shoe in this regards. So as of now, I have seen, almost of most of the periods of time, ASK portfolios have kept financial services as its top sector, in line with the benchmark. Now, when we see the big picture, today India's economy is say 3.5 trillion, and market cap of Indian stock market is say 3.1 trillion, because we are at 90% of market cap to GDP ratio. When we project big picture over say 10 years, India's economy could be 10 trillion, and obviously market cap will also be closer to say 9.5 trillion if we consider the same market cap to GDP ratio. What do you feel? What is your understanding will be the contribution of financial services sector? Do you think the current weights like 30% will remain, or they will reduce, or they will increase in this regards?
As I mentioned earlier, neither I am a macro investor nor I am a theme-based investor or a trend-based investor. I am a very micro-oriented, specific name, specific opportunity, pluses, minuses, and whether it is worth buying into. But since you're asking a very specific question on a sector, whether the 28, 30, whatever percentage weight financial sector has in some of the mainline indices, whether in a growth economy finance will grow less than the other activities, probably not, because finance is really the key engine which enables the growth to happen. And therefore, usually finance is a condition precedent, not condition succession. And therefore, typically it is the finance and related activities which grow. And then they pull along growth of the other areas. Therefore, in the economic composition, whether finance would grow at a lesser pace than the other segments of the economy, at least for few coming years, I have no real data or reasons to believe that should be the case. In other words, finance and related services and activities in the businesses should retain their salience. And I would dare say in some cases it is likely that it may actually grow faster than the other ones. We must remember that lender balance sheets have become strong, borrower balance sheets are strong. The growth of the country opens up a need for more capital of various types. Financial instrument sophistication at our end has improved. Someday we might see G6 of Government of India getting listed in the international indices. That may easily open up new capital of 30, 40, 50, 60 billion dollars almost soon, as soon as that floodgate opens up. So, and the cost of capital is being brought into bearable territory. All these implies that there are many reasons to believe that overall financial lending activity in particular, but many financial services would do very well. And therefore, but in any case, we buy a business not simply because it is so much weight in the index or so much weight of that sector in the index. We buy it for a bottom-up reason. There are enough that we like in that area. Therefore, that is the reason why we are buying.
Sure, Bharat. So I asked that question, because what I have noticed and seen that today those fund managers, which give some significance to macro and are able to predict macro, developments, are actually able to maybe enhance investors' return. But yes, that could be a short-term scenario. In long term, the micro, I would say, finesse that you bring ultimately creates wealth because of longevity and consistency. I understand that, and hence I will stick to the micro aspect, which is your area of, I would say, strength. And in that regards, we have also seen, recent change in the investors mindset. Investors and many fund managers always used to say absolutely no to PSUs, but when we see today that there is India is at a cusp and big shift is happening, some fund managers have also started accepting that if some PSUs are available at good valuations, they should also be seen as maybe quality business. What are your views in this regards?
No, I quite agree. In fact, that is one area where there can be very the criticism leveled against us, that we have taken more time in embracing some of the superior PSUs into the fold. But clearly, there are areas, and thanks to government policies being very enlightened in those areas, have opened up wonderful brand new opportunities without any doubt. And the PSAs today, at least some of them, I would still say a lot of them are still held and frozen in the time of the past, but many of them are actually thrusting ahead and actually getting better and superior businesses. So there are important opportunities. There is no doubt about it. I would say this is second kind of a new wave after almost 8 or 9 years when PSUs were battered and bruised very badly. The whole basket of PSUs for 8 or 9 years suffered body blow and actually value was eroded. Now finally they're coming into their own. And once again, because of the open policies of the government, the right economic environment, the freedom for those businesses to do what they have to do largely in place, and the rules of the game being more clear, that is enabling many of the PSUs, so to say, to find their mojo and to get back to the opportunity, which for a long period of time uh, they were sorry. For a long period of time, many of them were, in a state of constant diminution, or if not decimation. But today, that opportunity is very clearly important, vital. Once again, we have to pick and choose. We can't just, buy because as a category they may look attractive and may be popular. Because in those kind of judgments, there is a huge danger. When tide turns, things can create a huge amount of problem. Therefore, maintaining discipline is very vital. But that said, many important opportunities, and we have to look at, and we have to suitably weigh the trinity of quality, growth, and the valuation combined. In the PSU category, also we have to be meaningful investors. We have some of them, but we need to get more of them, and that is the task which is on.
Sure, Bharat bhai, I think we'll move on to the last question of this webinar. We have been kind of, trying to address most of the questions that investors would have on their mind. And in that, I would say, context, because many investors here want to kind of hear from you today that yes, opportunity in front of us in Indian context is kind of huge. So should one ignore investing overseas in US markets or China market and absolutely focus only on India? Or, we cannot say like that, and some diversification still makes a sense.
Well, as an individual, I am not particularly fond of an artificial diversification. Diversification is supposed to reduce risk and improve returns for both. Only when it achieves that purpose, that diversification is intelligent. Either a diversification should meaningfully reduce the risk or should meaningfully improve the returns, or it should achieve both. Uh, Evidence on international markets is somewhat sober. Japan, as you know, has struggled for some 34 years to cross the previous index in 88 or 89 that it touched. And it is only a few months back that Japan has crossed that 34-year back index number just now. South Korea is still behind the index that it attained in 34 years ago. And South Korea is meaningful minus percentage on that index number even after 34 years. It is equally sobering to see that many European markets, even in a decade, have produced negative returns, even after a decade. So it is not 2 years and 3 years and 4 years, a short period that I'm talking about. In equity markets, 2 3 years is a fairly short period, and therefore things can look accentuated either way. But 10-year market returns being negative indicates structural issues, and it is not low returns, it is negative returns in some of the markets. As far as Chinese as far as the Chinese markets are concerned, the evidence is in fact far worse. Even on a 3-decade basis, Chinese markets have produced less than savings bank returns compounded over a 30-year period. Now that's long period. And that 30-year period coincides with one of the most dramatic economic expansions in the history of the world that China has witnessed. Therefore, once again, I'm sorry, I'm having a bit of once again, that reminds the danger of getting carried away by macro investing. Macro, you can construct very elegant kind of theories and stratagem, but investing remains essentially a micro investing, micro task. That particular business, that particular management, its cash flows, its durability, growth rate, quality of growth, value, and discipline to buy it at margin of safety. There is no substitute for that. Sorry. So China, even after 3 decades, has struggled to provide, forget about cost of capital, but well below cost of capital, low single digit, less than savings rate returns in India, kind of returns over a 30-year basis. Only I would say a meaningful exception would be America, where is a system, there is innovation, there is entrepreneurship, and there is a very strong capitalist system. Even though it is witnessing a lot of attack and threat over last few years, American capitalism is also altering in a significant way in last few years, given the kind of political change that it is witnessing. But all said and done, American capitalism system still is entrepreneurial and highly innovative, especially in areas of technology. They continue to remain leaders. Entrepreneurship also is largely in area of technology. In other areas, I think entrepreneurship is materially abated. But whether America will do as well as it has done in last 30 years, I have my doubts. If you look at last 30 years, America has been number one market in the world in terms of returns, some 9.3 odd percent compounded in dollar terms. India has been almost close on the hills to America at about 8.4, 8.5% dollar compounded returns over a 30 year. And India has been the second best market in the world in 30-year period. The American market had a better growth rate on a relative scale, on a large economy. They grew decently on a 30-year basis and had a superior quality of growth, and therefore the two together produced the best returns of any market in the world. But I think going ahead, America, in my opinion, will have a growth challenge. And given the fact that innovation and entrepreneurship are largely in technology area, overall system quality is somewhat suffering than in the past. And there are other challenges that American capitalist system is witnessing from within. And therefore, my suspicion is America will find it very hard to get the same returns of that 9.3 odd percent that it has delivered over last 30 years in the next, say, 20, 30 years. India, on the other hand, I think growth rate will be distinctly superior than what it has done in the last 30 years on an average. And I think quality of growth rate is materially superior compared to what we have witnessed in the last 30 years. So I think India has raised the game, and therefore, in all probability, there are good chances that for the coming decade 2 and 3, India might turn out to be the number one return generating market in the world. So India and America, I would say, other markets, whatever little I know, and not that I know enough about any of those markets so much, but whatever little I know is not particularly enthusiastic kind of situation. And therefore, mechanically diversifying for the sake of diversifying, I would put a red light on that. But America could probably be still an important element of the plan. May not be the large one necessarily, but may continue to be an important element, I would say.
Why, thank you so much for such an enlightening discussion. I think we have covered almost, all thoughts, all questions, all ideas that come to my mind, and my good wishes to you to kind of, steer the ASK's performance for the next decade. I'm sure we'll see India at 10 trillion. I'm sure we'll be doing, webinar with you on ongoing basis, and we'll be discussing all the risks that come our way, along with all the opportunities that we have always been talking about. And absolutely, we have to be optimistic in this context. And yes, I agree with you that too much focus on macros at times is very risky, and not to kind of uh, uh, leave the focus on micro is a very, very important aspect, and that is something that creates the maximum wealth in longer term. And that's exactly what ASK has done, and that is why ASK deserves and has been able to reach that position. Thank you everyone for logging in today. I am again giving a piece of apology for starting late, and we'll be again connecting next Friday with another thought leader like this, and that's Mr. Madhusudan Kela, who is going to join us on 29th of September. So till then, keep kind of watching our webinars. The intent is very sincere, and we are here to kind of add value to our clients, to our investors. Please, Bharat Bhai.
Just wanted to add one note to the conclusion. Investing, investing is absolute. Relative is a byproduct. Though world in general tends to treat investing more in relative terms. You can't blame people for thinking that way because Homo sapiens are hardwired that way. But investing truly is absolute, is the first principle. Relative superiority is actually a derivative. We have always, principally and as an idea level, philosophically, I always believe that we must have a capability to produce absolute, positive, compounded, healthy outcome over a period of time without any reference or without any excuse referring to miss the market. And therefore, it is our duty to generate positive outcome over a period of time. Over a period of time is an important descriptor there, or that we must attain, without any reference to miss the market. That said, relative superiority also is an outcome which will happen as a byproduct when you remain focused on the purity of absolute. Therefore, when we remain focused there, relative superiority of an outcome will happen, has to happen. And any investor, any manager is duty bound to achieve both, to get a satisfying absolute and relatively superior outcome over a period of time. All that you need is a meaningful period of time through which ironies and ups and downs and oddities and occasional kinks in the marketplace get sorted out, and finally distilled outcomes become visible. Over that meaningful time frame, we have to generate satisfying absolute and gratifying relatively superior outcomes. And philosophically, I remain committed to both. We as a investment house are deeply committed to that idea.
Sure, Bharat bhai. I would again, iterate on the aspect which I always kind of am reminded of whenever we conclude our sessions with you, that, I think life teaches most significant lessons, and those people who learn from life are most successful. And you are definitely one of them. I can see that, in all these philosophical as well as logical conversation that we have done. And many clients ask me that what are the fundamental attributes to judge a fund manager. I always say one of the most important is that one of the most important is humility and good learning capabilities. And that is what, I always see whenever I kind of, interview you or anybody from ASK. And at the same time, we have seen, various recent fund managers who have come and made their mark, but they kind of miss this aspect, which is humility and good learning attributes. And that's where kind of, their journeys may be going to be short lived. But absolutely, on this note, I would again thank you for giving us time today, and thank you everyone for joining for this webinar. Thank you, and once again, we'll be again joining on 29th of September with Mr. Madhusudan Kela from 4 to 5 p.m. Again, keep watching these webinars for more insights.
On that, just one last sentence, learning and that you mentioned, in fact, remains defining reason why one should be an investor, because there is so much of learning markets expose you to, that it throws that opportunity to constantly learn. To my mind, just the learning itself is a gratifying enough reason to be an investor. All other things actually are really extra. But markets are a great teacher. It offers a great learning opportunity. And if you are excited by that thought of learning, probably there is no other place than the markets, in my opinion, across so many branches of knowledge, so many branches of which kind of combine together like a lattice work and give you that opportunity to build rising ecosystem. Also, if we do not remain on that learning mode, the second aspect that you mentioned happens. When we lose that reasonable spirit within, markets don't forget to give you a hard and probably very bruising knock. And therefore, I remain reverential before market. Not that markets don't make mistakes. Markets time to time make mistakes. Time to time may get carried away, both on the positivity or negativity. But over a period of time, markets are very clinical and very, very almost axiomatic over a period of time. And therefore, I have nothing but a deep admiration and reverential attitude towards ability of markets to filter through so many variables and eventually come to the truth on a long-term basis. So on that, I bow down before it at any point of time. And we all have to remain aware of the fact that markets are supreme.
Absolutely. Markets are 100% supreme. Thank you so much for your time. And I really kind of, value all your views. When we started this webinar 15 minutes with delay, there were a few, I think, subscriber participants who were kind of asking whether we'll be able to continue for 1 hour, but we have exceeded 1 hour despite, we starting 15 minutes with delay. So your speaking time was more than 1 hour, and it like went on so smoothly because it were all words of wisdom. Thank you so much once again. Thank you everyone for joining us today.
Thank you very much, all the participants, Kamal, and my apology for that late start. There was a reason, but I'll not justify it with that. And deeply gratified to be amongst all of you.
Thank you.
Thank you. Bye-bye.